amazing what you can do in post-production.
Just have AI do it, right?
That's right.
Yeah.
We're one step away from having AI just replace our gigs here. What do you think?
Yeah, I think we actually ran. Who is it? Google that does it?
Oh man, have you tried this? You know, Google has this. Have you seen this? You can go on Google, some sort of.
You can tell him now that he came on because we're going to force him to do this show, and then the next one he's going to AI generate. But yeah, Google has a service where you can give it a prompt of what you want the podcast to be about. Right. Yep. So we can say it's a commercial real estate podcast. And today we want to talk about Heitman and their portfolio and the things that they're doing. And it'll have 2 guests and they'll banter.
They actually have banter.
You're kidding.
No.
Naturally.
That's crazy.
And it's the craziest
Sometimes you'll
thing.
actually find it funny. Sometimes I'll be like, oh,
it's all just computer generated.
Brian, it's terrifying.
Yeah.
It's terrifying how good it actually is.
Here's what we should do. We should do a comparison of how we'll do it with Heitman.
And see who gets more hits.
Yeah, we'll see who.
That's insane. I mean, that just blows my mind.
Yeah.
Me and Jack are going to cannibalize our own podcast.
What I think we should, just for fun, be like, okay, we're having Heitman on. This is what I want you to talk about, and then literally, like let's just compare it.
All right. Say goodbye to our jobs,
and it will generate a person and its voice,
2 different voices.
Content.
Yeah.
Yes. And it will sound natural, as if they're like reading notes.
Yeah. By the way,
really
this isn't even new. We were talking.
Yeah.
I think we first found this like a year ago.
As soon as it came out.
Yeah.
No kidding.
Yeah.
So,
and it was good then. So it
can only be even better now.
Yeah. It has to be better.
Yeah.
Well, thank you for coming on.
My pleasure.
Thanks for coming to New York exclusively for this, and definitely nothing else in New York. Nothing else.
I see Heitman a lot. I see it. I see it in the news a lot. I follow. I think we both follow a lot of what you guys are doing. So it's nice to have.
And historically, I've worked with your debt team, and they're obviously really active. I know you guys raised. You typically raise it in a fund structure or like separate accounts?
We have separate accounts and funds.
Got it.
Yeah. So it's about a 50-50 split of our business today.
Nice.
But yeah, it's mostly institutional investors.
Sure.
Some high net worth, but again, mostly we've been in business for 50 years. Started just on the equity side of the business, and then have morphed into the debt team and growing the debt business, originating first mortgage loans to sponsors.
Yeah. Well, let's get into that in a bit. Let's talk about first like how you got into Heitman, and it seems like you've been there a while. I mean, you started off at Heitman.
I'm a lifer.
Yeah, which is so rare.
Yeah.
Yes.
It's rare, and it's usually like we're gonna have to launch a vertical for No Cap that's kind of like acquired, where we dig into the real estate companies, because there really is something to say about people who have been lifelong with the real estate. Almost never happens. Yeah. We rarely see it. So curious to hear your story.
Sure.
Where are you from originally?
I am from the Chicago area originally. I grew up in the north suburbs. I went away to school. I went to IU as well, as my son who's there now. And I had an early interest in real estate. My dad was a contractor, and so I got sort of the touch of real estate, and I thought that could be an interesting job. I was always good at math, so I went away to school. Indiana had a real estate program, one of the few schools back then to do it outside of sort of Wisconsin and Penn. And so I came out and I was looking to be back in Chicago. I knew there was sort of an up-and-coming real estate industry in terms of commercial real estate.
Mm-hmm.
And so I landed an internship with Heitman and started work there after my sophomore year. And I really liked it. It was a large company at the time, did a little bit of everything: property management, leasing, and investment management. I went back for the next summer, and the landscape was shifting a little bit in the industry. The REIT industry was coming to life, and Heitman had a small securities business at the time, but REITs were really starting to it was their time. So you started to see a lot of IPOs, people taking private portfolios and taking them public.
This is early 2000s?
This is the 90s.
Late 90s.
Yeah, this is late 90s. And so Heitman was in the same boat, trying to figure out what the future was going to be. And they went down a road at the time of potentially taking portfolios public. And so I got to work on that as an intern, which I thought was pretty cool. It didn't end up happening, but I went back full-time after that, and I was on the acquisition team for private equity. So, that was the part of the business I found the most interesting. It was no days the same.
Mm-hmm.
You're always looking at new opportunities. You got to travel. So as a young person, I thought that was pretty interesting. And long story short, the company had sort of gone through a transition of ownership and leadership, sort of right when I started. And so I was sort of in at the ground floor of Heitman 2.0. And
where's the name Heitman come from? Who is Heitman?
Ironically, it was there is no real history around that.
I couldn't find it. So
yeah, so there's
no Mr. Heitman.
There's no Mr. Heitman. There's no Mr. Heitman or Mrs. Heitman.
This is bizarre. This is crazy.
The four founders of it liked the name somehow, and they threw it onto their business.
I like it.
It was a small. I don't think it was residential, but it was sort of a broker, a commercial lending broker business. And rather than kind of create their own thing, they just bought it and started what would become the first generation of Heitman.
This is crazy. I had no idea.
Cool. Yeah.
Well, tell us a little bit about, when you're part of Heitman 2.0, early years, what was the portfolio like? I mean, you said after your summer analyst role or whatever that was, you're focused pretty much on traditional M&A, and then you went for asset acquisitions. Like, what were they looking for at the time?
Yeah, it was largely a core business. So institutional investors were looking for high quality real estate that delivered stability. So leased, good location, newer vintage. So we were buying, at the beginning, apartment buildings, office buildings, warehouse, shopping centers. Pretty straightforward. About 2 years after I started, we really started to lean into some of the alternatives. So think self-storage, think medical office buildings. And at the time, I was
pretty early on. It sounds like
it was very early on
in those alternative classes.
They were non-institutional real estate at that point. And when we first started looking into it and understanding the sectors, a lot of our clients were, that's not core real estate. That's not institutional real estate. So we had to do a lot of work early on, sort of building the case for why those alternatives should be part of an institutional investor's portfolio. The different drivers that make them complementary to the other stuff that they were already doing. Hindsight 2020, we have always been, I'd say, less enthusiastic about commercial office. From the first day I started, the team at the time just thought it's big, it requires a tremendous amount of capital to keep it relevant, and tenants are unpredictable. And so we underweighted portfolios that we manage for clients. And when we started our funds, because at first it was mostly separate account relationships with large institutions, and then we launched our first commingled fund, which was a closed-end value fund in 2003, underweight office. And then in 2007, not ideal timing, but we launched an open-ended core fund, so an Odyssey fund. And even in that, the strategy in that fund from the beginning was underweight office heavily. In its place, what did we do? We put self-storage in there at a very heavy weighting. So 20% of our core fund out of the gates was going to be weighted to self-storage. A lot of doors got slammed in our faces. A lot of doors also opened for institutional investors that were a little more open-minded to changing what their portfolios looked like. A lot of that because they also had public portfolios. So they had REIT portfolios. And they could see what was happening in the REIT industry, which it was transforming at a rate of change much faster in terms of its diversification of property types than the institutional private real estate market. And that stays true to today, where if you look at the construct of institutional private portfolios versus the public REIT universe, I mean, it's property types some people haven't even heard of anymore. And yet, while it's changed, the rate of change is still slow. But you're starting to see alternatives become a bigger part of a lot of institutional investors' portfolios. And we've been doing it amongst the longest in terms of investment managers in the business.
How are you balancing these alternatives today? What percentage of your portfolio would you say is?
Depends on the strategy. It ranges from where we have some closed-end funds where it's upwards of 50 to 60% of the weight of the portfolio.
Mm-hmm.
So in addition to that, we might be still doing some industrial, we might be still doing some multifamily, but a lot of it has gone towards self-storage, medical office, senior housing, student housing,
Mm-hmm.
build to rent, single family rental. So it's really diversified over the years in terms of the expertise that's been developed by a lot of these operators for these very niche asset classes. And we've not only done it here, we've done it sort of around the globe. You know, self-storage being the longest track record we have of almost 26 years. We started here, we went to Europe, we went to Asia. And so now we've got established sort of foothold in self-storage globally.
Lev is simplifying the most tedious parts of commercial real estate financing by bringing it all into one single platform. Use Lev to find new lenders matched exactly to your deal specs, manage all stages of your pipeline, and maintain relationships with your network. With Lev, you can keep in touch with your network, plus connect with over 7,000 active lenders. They're also just launched the newest version of Lev Memo, which uses your uploaded information to generate OMs with the click of a button. See how easy debt financing can be and why Lev users are launching over $3 billion in deals every month. Get started on lev.com today. Very interesting. You know, self-storage is something that I think we've learned a lot about since we've, started the show. We had on Chris Burnham from Storage Mart.
Chris,
I know Stan Kroenke's a big investor of his.
Absolutely. Bill Gates now too.
Yes, right. Yeah. But what's interesting about self-storage is just how it's kind of taken off across the world a little bit more.
Yeah.
What's your take on that? I mean, it seems like it's a very American thing, but now it's
I don't think there's anything more American than self-storage.
Yeah,
you're right.
We are the hoarders of the most.
We
junk.
love our trash.
Yeah.
We refuse to get rid of it.
That's right.
And that is good for self-storage. But what we've seen is it's starting to get traction in terms of being accepted and understood by the population in Europe.
Is this with
Asia.
the growth of like Amazon centers effectively
I think it's
overseas?
Exactly. It's people buying more stuff.
Yeah.
Even though Europe traditionally has been very utilitarian,
right? Minimalist.
Minimalist. They've started to enjoy stuff. And I think also a big driver, particularly in Asia, is just the size of people's accommodations, right? Smaller.
Right. Yeah.
They don't have space for
tiny
stuff.
homes, efficiency.
Tiny homes.
Yeah,
that's a good point.
And then on top of that, the pressure of people, it's not just sort of one nuclear family, it's generations of people living together. And you see that more in Europe and you see that more in Asia. And so we've seen it come along. And if you look back, if I had to pin it on a number, the European demand side of the equation is probably 5 to 10 years behind the US. Asia is probably similar. Australia being in that part of the world, a little bit more like America.
Right.
So they do buy stuff. They're a more consumer-oriented economy, and they adopted storage earlier than other areas of Asia.
Yeah, it seems like the UK, Australia, and the US all are very kind of like-minded when it comes to storing their crap.
Definitely. And then beyond storage, it starts to parallel into other real estate delivered to meet a need for some part of a person's life. Healthcare. Never really institutionalized in Europe or in Asia, and you're starting to see it happen. Europe first, Asia slowly. Student accommodations, definitely in the UK happening pretty significantly. Starting to happen in Europe, where it's not controlled by the government, where it's controlled by private investors. And you're even starting to see some of that pop up in Asia.
And what does that look like? Is it more homogeny in the sectors? Like, is there branding? Like, what makes the institutionalization of those assets?
So to see how far it's come in the U.S., it's probably a good place to start, where at first it was homogeny. Everything was the same. It was a mousetrap. Build them cheap because they're going to get destroyed. Now they've become where companies have defined themselves by their brand and what they have in these facilities. And I don't know the last time you guys have been on a college campus, but some of the newer
Alex
places,
hangs out at college campuses
regularly. So I'm there a lot now because I've got 2 kids in college. But I will tell you, it's almost teasing these poor kids into, you're going to live now in a nicer place in college, because when you get out of college,
really,
your
dude,
first
it's
place
so
is going to be
funny.
terrible. But
It's so true.
they have golf simulators and tanning beds and
Right.
rooftop pools, and it's ridiculous.
They probably have to compete 10 times more than.
It's an arms race.
Yeah.
It's like the apartment world. It's transformed, except you're doing it in these small towns. And you're doing it in a population where, depending on the school, the subset of the students that can actually afford
Right.
to pay for these units.
I had a deal on the market, Class A, new build at Stephen F. Austin University
Okay.
in Nacogdoches, Texas.
Yeah.
I feel like I don't know what that is, but I feel like you made it up.
It's part of the
I know
UT
Brian's
system.
smiling. It
Exactly.
sounds
I'm
like he
familiar with
might
it.
know what it
Yes,
is.
It's a big deal.
I feel like
They just had their largest
in.
enrollment class,
Yeah.
freshman enrollment, and
Yeah, all right.
ever. So this is huge. Anyways, it's exactly what you're saying. It's small town.
Yep.
Not a whole lot going on there, but these properties were just top notch,
Yeah.
like just in terms of amenities.
and they lease up fast.
Right.
They're sold out the day they open. There's a line out the door for kids to get deposits. The problem is the next one's going to get built. And
Yep.
then
Yeah.
that one that got built becomes irrelevant in a few years, and you have to invest more capital in it. So it's a pretty wild mousetrap. In Europe, it's very still
Yeah, what does that
commodity,
look like?
right? It's not amenitized to the T's. It's there for kids to live in
And
go to
actually
school
learn.
and go to school.
Isn't that funny? I mean,
kind of ironic, right?
Actually learn. Who knew?
Brian, how much of your portfolio do you think is outside of the U.S.? Or
Today-
at least on the equity side, or I don't know if it's commingled.
So globally, we manage about 50 billion of AUM, and the majority of that is in the U.S. So I oversee the U.S. private equity business, and the AUM in that business is around 34 billion. So then, if you look at the other sectors, so we've got about 5 billion of AUM in Europe, and that's largely in alternatives. So it's mostly self-storage, student housing, and some build to rent. And then we've got about 3 billion in Asia, and that is a mix of retail, office, and some self-storage. And then we've got the private debt business, which I mentioned we're in and that you've interacted with. That's about 4 billion of AUM. And then we have a small securities business as well that buys and sells REIT stocks for investors.
Tell us in your role, like what does that involve? What's your kind of day to day? What do you focus the most on?
So my day to day. So for a long time, I was in the investment side, and that's solely where I was focused. So about 3 years ago, we were going through succession planning, and some of my partners were thinking about, the next step for them. And so at that point, the gentleman who was running our North American business, who had been doing it for a long time, said he wanted to start to step back, focus on a specific fund that he works on. And so I was asked to take over leadership for the whole North American business. So step out of acquisitions, although it still falls under my my domain. But then I also picked up all of our asset management team, our portfolio management team, and then we have a closings team as well. So my days are really a lot of meetings with all the different leaders of all those different functions to understand what's going on. I still am pretty heavily involved in the investments. I love it.
Well, you come from the acquisition side.
Yeah, exactly. So
yeah.
and it's just in my blood, and that's where all the action is.
Yeah.
But it never ceases to amaze me the interesting fires that pop up every single day in a large, diverse portfolio that just you need to jump on and figure out. And then I also spend a lot of time now with investors, talking to them about their portfolios, strategy, and I spend time with the capital raisers for new initiatives, raising capital.
So you're wearing a bunch of hats.
It's a bunch of hats.
Yeah.
And it's a lot of people time. So it's a lot of, instead of working on a specific deal, negotiating a joint venture agreement or a purchase and sale agreement, now it's making sure the team is focused on the right areas and making sure that the leaders of the different disciplines have the resources that they need, and communicating down from, what our philosophy is from the leadership team of, what we want to be doing, where we want to be focusing, and what's interesting.
If you're managing debt in commercial real estate, it's worth checking out Lev. Lev's the AI platform for commercial real estate. Lev gives you one place to find lenders, launch deals, and keep track of responses without jumping between emails, spreadsheets, and CRMs. You can see everything that's happening with a deal across your team, all in one dashboard. Get the benefits of AI automation without the headache of building agents yourself. It's fast to set up and easy to use, and it's effective. Lev users are launching over $3 billion in deals every month, and they are loving the results. Visit lev.com to try it out.
So it is rare, like we said, that somebody is lifelong with one company, right? Yeah. And at least guests that we've had on the show who are at your level, they've moved around throughout their career, and sometimes horizontal, laterally, whatever it is. But I think to some extent, they have to lose sight of what the original business was, and they all get various opinions about fund space and how things are moving. From your perspective, what have you seen different in the fund world over the last, 5, 10, 15, 20 years? What's really changed in the business for you? What's gotten better? What's gotten worse?
Sure. Well, I think the proliferation of funds has helped the business be more efficient. So when I first started, like I said, it was mostly separate accounts. So it's non-discretionary. Every decision you make has to be approved by the investor. So it takes time. It's slowed things down. Then the proliferation of sort of discretionary investment vehicles, and it started with, a lot of value funds, closed-end funds. So investors allocating capital to a manager with a mandate, with an investment window, total life fund. You got to sell by this time, deliver us a certain return based on a strategy. But it gave discretion to the managers. Now, we were investing our own capital. We're the GPs, so we're investing our own capital, so that you like that alignment. But it allowed for, what I saw when that started to happen was the acceleration of transactions, the acceleration of the business. Things were happening faster. And then you moved more towards sort of the real emergence of the Odyssey funds, the core open-end funds, which there have been some that have been there for a long, long time. But then there was sort of a big wave of them sort of in the mid-2000s, and then post-GFC, there's been a wave of new ones as well. And those are big, diversified funds, again, allowing for the buying and selling of real estate to become more efficient because managers can do it more efficiently when they have discretion. Now, again, managers are investing alongside these institutional investors, so there's alignment. But it just allows for a easier transaction environment. It's also allowed, I think, the creation of a lot of these nichier asset classes to become more mainstream because as these managers get more discretion, they were allowed to go and explore new opportunities. And that really started to occur in sort of, the mid to late 2000s. GFC put a big dent in a lot of people's growth plans. But coming forth to today, where now you're starting to see asset-specific funds, multifamily funds, you name it. There's data center funds, and they're gaining a lot of attention because people want specific exposure to certain of these asset classes. So we're seeing a change in the business of, some investors are choosing to pick the sharpshooters versus allocating to allocators, right? Where we're going to build you a diversified
for
pool.
them to build it for them, right?
So for us to build it for them versus them going out and finding, hey, you do this, you do that, you do this. I'm going to give you money. I'm going to give you money. I'm going to give you money. So it's changing. It's been evolving to that. Now, will that stay? One thing that I've seen over the years is where institutional investors choose to invest their real estate capital. It's been growing. So is a percentage of their overall investment book. It's been steadily growing, which is good for our business. But it changes and it ebbs and flows from sort of where they are on the risk spectrum. At periods of time, they go core. And then you start to hear about core getting overpriced. Well, it's because there's a lot of capital chasing it. And then they'll morph into value add as they're maybe chasing return because core returns get pressured from supply capital. And then occasionally some of them will go out to opportunistic where they're really taking risk, unentitled land, buying land, stuff like that. it always swings back. And I'd say where we are today is there was a tremendous amount of capital raised for value add investing over the last 5 years because of the interest rate environment and banks tightening lending requirements. There hasn't been a lot of activity in the value add investing space.
Mm-hmm.
And so that's put pressure on not only investors who need to get the capital invested, they've got these commitments out there, but it's not being invested, but also it's put pressure on returns. And I'm sure you've read it in the paper, office buildings, people who invest in office are taking some losses.
Mm-hmm.
It's taken a little longer than I think people thought it would. But if you look at the big indexes, real estate's roughly down 25% from the peak 3 or 4 years ago.
Yep.
So now what you're starting to see is institutional investors slowly flowing back into core and core plus. And so that's why it's important for us, Heitman, to have a variety of options for investors. We do core plus, we do value add. And so we can lean into where the capital is coming depending on the nature and desires of the institutional investors from day to day.
So Brian, are your institutional investors these days becoming a bit more specific in what they want you to do and their directives and where they want to put their capital into, rather than letting you just kind of allocate on your end?
Some are, some aren't. Some just, they like diversification, and they like being invested with large managers. And so they're not necessarily willing to take risk with smaller operator-focused funds. But there are certainly plenty of institutional investors that are doing that. And that's why you've seen that proliferation of all those sector-specific funds. So I'd say it's a mixed bag. It depends on the size of the investor. And then there's still a lot of institutional investors that still want control.
Yeah.
And they know they have to invest in funds because they have to get capital allocated and invested in the market. But they also still have large books of separate accounts where they can manage. Largely, those are core portfolios. So think of the best real estate out there, the shiniest penny. Those are largely owned by institutions in a non-discretionary format, meaning they control it, they own it for a long, long time. And we own some assets that we've owned for 30 years that are phenomenal pieces of real estate. Locations can't be replicated, have been well leased since day one. Yes, you're investing capital all the time to keep them modern and in demand from tenants, but
there's equity value.
There's tremendous equity value in there, and there's good return. And so you still see a large sector of the institutional investors desirous of keeping, those sort of trophy assets. I'm going to own them. I want to own them forever, and I'm going to make all this.
It's a funny comment because I see that a lot, especially in New York, on the office side, right? If you have truly an institutional grade office, and I say that with, it's got to have the floor plate that can have real credit tenancy, right? Where a pension can own or somebody else. I always, my initial conception was that, these things, they're real coupon clippers.
Yeah.
But then when you look into it, there's no coupon. You're constantly reinvesting in these things. And I never understood. I was like, so what is attractive about this asset?
Yeah.
And it's really just the embedded value. If you have the right location and it's resilient and, it's got whatever you need, then your appraised value grows and on paper grows.
Right.
Well, in theory, right? Because if there is a core buyer, at some point, there's an alignment between the floors and there's no roll for a long time.
Right.
But generally, that's not the case. And I never understood that. And so I think you might be the first guest on here to address that issue.
That's for sure true with office. You do get to good days where you have, staggered rollover. You've invested heavily at one point in time in, plant and lobby and
there's liquidity events you can,
and there's the refinancing events. You can capture value through that. But you do have to invest a lot of money to keep them relevant.
For sure.
And that is a part of the deal with office buildings. And office is going to have a place in real estate portfolios. But there are winners and there are losers.
By
and
far.
there are a lot more losers. And some of them probably don't even know yet that they're going to be losers, but they will be. But you see the resurgence of the return to office, Manhattan's fantastic. I mean, you can really feel it. You're walking up Park Avenue. There's people. The buildings are full. The good buildings. You go to other parts of town, and that's, Chicago, LA, San Francisco, same thing. It's there are good buildings, and then there's a lot of buildings that who knows what's going to happen to them. And that has to be figured out.
New York's actually the easiest microcosm to figure out because the concentration is so tight, right? If you're Park, Madison, 5th, 42nd, 59th Street, it's very easy to pinpoint. Where I'm curious is like, how does that look in places like San Francisco, which has winners and losers, but that city is so spread out. How do you pick the winners in that market? I can pick winners in New York all day long. It's really easy. How do you do it there? How do you do it in DC? Chicago,
DC's tough.
To an extent, like the loop is where you want to be. So it has a similar factor. I don't know how you do DC. Miami is another one. Brickell's been the early days, but it's also early days of their whole office market down there. They've never had this
West
much
Palm Beach is
competition.
now an institutional market.
But luckily, that one is so tiny that you almost can't go wrong. But Miami, maybe one day they're going to decide they do want to be south of 5th and they all want to move back to the beach. And
Are you guys involved in a lot of West Palm?
No. It's been a market that, we've invested in over the years in small, apartments.
Jack, the name's Heitman, not Ross.
You're right.
You have to have a specific last name.
I said we've always been underweight office, and it really served us very well.
What about offices? Less attractive little sister industrial. Similar constructs.
It's going through its challenges right now. All the big Amazon boxes, bombers were all the rage, and then they got overbuilt, and now you're really seeing pressure on rents, and it's shifted more towards what we're seeing is smaller utilization, so smaller size assets, more towards how do I describe it? Where it's a user that needs some storage but also needs some office space. So sort of
flex.
It's flexy, but it's not flexy. It's still warehouse. It's called shallow bay. The bombers are still out there, but the question is who's going to fill them? And Southern California, the LA market, which was on fire for coming out of COVID. I mean, you were seeing 25, 30% rent growth year over year.
Wow, really?
And you couldn't build it fast enough for the demand. And then it all turned off. And so now, luckily, most of it's been delivered, but a lot of it's vacant. And rents have come crashing down the opposite way. So a market that historically has probably been the best performing market in the entire U.S. because of the tariff policies or the unknowns around tariffs. Users are just waiting. And that's happening throughout the country. But if you look at the Midwest, Chicago, Indianapolis, Kansas City, Columbus, it's been a little more sticky there. It's been because it's serving the population, and those populations have been relatively stable, and it's affordable, so people aren't moving to more expensive places. So it's held up. The industrial markets and warehouse markets there have held up quite well.
I'm curious what you're seeing in that kind of macro data. I know for a lot of operators in the space, the story 12, 18 months ago was, we're buying these at 4 caps because with the rent growth, you're getting to mid 6s, 7s, which sounds phenomenal. But I'm always really scared whenever an asset's entire plan depends on rent growth. So how is that, 30%, 40% scale back in rents actually affected that trajectory? Are people now just sitting on like 5 cap industrial with 5.5% debt?
That's right. That's exactly what's
really
happening.
Scary.
It is very scary. You've seen industrial values really correct because of that dynamic, which is cap rates got so low, and a lot of instances they're locked in there for quite a long time. People were signing 5-10 year leases, and at the beginning, industrial's traditionally been 2.5-3% contractual rent steps. When the market started getting really hot, it got into the 4s, but still, to work your way out of a 4% or 3.5% cap rate, even if you get 4 for a few years, you got to hope cap rates stay low and cost of borrowing stayed low. Well, the minute interest rate shot up, you immediately saw a full stop on transactions as people were trying to figure out, what am I going to do? Am I going to pay a 4 and borrow at a 5.5? Well, that doesn't make any sense. Why should the cost of debt be cheaper or more expensive than the cost of equity? That's upside down. So you're starting to see transactions happening again as rates have fallen a little bit. So to where you're about neutral, but that's at about 5. So those people that bought at 3.5 or 3, they're still underwater. Now, maybe they've experienced some contractual rent growth, so it's not quite as bad. A lot of them are owned by large institutions, which have staying power. The REITs have staying power. They don't need financing to hold on to them.
There's got to be a fundamental shift in the landscape where your cap rates, compress, or there's something, rates are only going to drop so much more.
That's right.
Yeah.
That's right. And then that's what sort of I think people are waiting to see is, okay, maybe rates are going to come down a little bit. They're not going back to the good old days of free money.
And I think everybody's finally in agreement with that, right?
So
We're
then
all aligned.
where does it settle? Does there need to be a spread over the cost of financing in a cap rate? These are the questions that are sort of being asked right now.
Yeah.
And again, a lot of the patient investors have the luxury of holding on and sort of waiting it out a little bit. I think even some office owners have the luxury of waiting it out a little bit to see. But eventually, when transactions start to appear, that's when you're going to get, okay, how bad really is it? And again, some aren't going to necessarily care, and they'll say rent growth is going to come back because supply. The good news is supply is shut off. Industrial supply is, I think it's 15-year low right now. You're seeing some build-to-suits being built, but beyond that, nobody's building spec anymore.
Yeah, right.
So you're starting to see absorption. I think last quarter, the quarter before was the first time we've started to see positive net absorption in some of these larger industrial markets where supply just exploded.
In how long of a period?
In how long of a period?
Yeah, like over. You're saying first quarter.
It was negative for probably 8 quarters. I mean, it was bad. I mean, supply was just pouring in, and demand had shut off, and so now we're finally starting to see sort of it bounce off the bottom.
Well, this is sort of a similar narrative to multifamily right now. No,
I think so. Yeah, absolutely. And in certain markets have held up pretty well because there was no supply, but certain markets got, the Southeast got tremendously overbuilt. So
what are you seeing in multifamily? Are you seeing a big dislocation to take advantage of, or are you guys?
We're seeing that in areas where supply has never really become an issue, it's probably a great time to build if you can. So like we're building in Southern California in a few locations, incredibly difficult to get it done. Rent growth strong. The Midwest has performed extremely well because there's been no construction. And it's this weird dynamic where single family homes values have skyrocketed. And so they're not affordable anymore given the cost of financing for people's first mortgage. And so people are staying in apartments longer, and there've been no apartments built. So you're seeing tremendous rent growth in places like Chicago, in Minneapolis, in Indianapolis. It's just places you never thought you'd see rent growth. You're seeing it. Southeast, it's been tough. I mean, it's we've exited a few properties that, there's just too much supply still coming, and it was a good return for us, but it wasn't a home run that we maybe thought it was going to be.
Is this always on the equity side or on the debt side as well?
On the debt side, apartments for the most part have held up okay. Most of the challenges have been in office.
Okay.
With particularly transitional office that wasn't necessarily trophy office. In markets that I wouldn't say were considered marquee markets.
The news is important, but if you're a busy real estate professional like me, you don't have time to skim through dozens of dry and ad-filled media outlets each day. That's why I read the CRE Daily. It's a free email newsletter that cuts through the clutter and delivers concise, witty commentary on the latest trends and transactions in commercial real estate. If you're a commercial real estate professional, you owe it to yourself to try it out and stay on top of what's happening in the industry. It's only 5 minutes a day. Visit credaily.com to sign up for free.
Well, you're talking about home values, and I always mainly kind of talk about multifamily, but the BTR space is super hot right now. You mentioned that you guys are involved in sort of the BTR SFR in Europe, which I think is very interesting. What are you seeing in that space in the U.S., and how does that compare to what you're seeing overseas?
Yeah, so in the U.S., we're build-to-rent's we've been pretty heavy into developing these communities in sort of second ring locations in southeastern markets.
What's an example of a
think like
that?
outside, 20 miles outside Charlotte, for instance. But you're building these fully amenitized communities where everybody has a single family home, but they also have all the amenities.
Mm-hmm.
We've also done scattered site SFR acquisitions, which is a much more challenging business. And the two BTRs a lot like apartments, right? It's a community.
Purposefully built, right next to each other.
Yeah. It's on site. You have a management team on site versus the scattered site, which is
you're trying to amass a portfolio
it's not
in a market,
contiguous.
non-contiguous, all different.
Right.
You're buying houses, so it's
right. Different vintages,
you name it.
And it seems like a real mom and pop sort of private capital space traditionally. I feel like as the SFR area where you have, a family or someone just kind of buying up individual homes.
That's how it had been for a long time.
It's very
then the
American
institutions,
dream.
it is. And then the institutions kind of jumped in.
And ruined it for everyone.
During the GFC, Blackstone went in big time and bought.
And they got a lot of heat for it. Everyone kind of thought
did.
they're single-handedly driving up prices of homes.
And I'm sure everybody's, even mom and pops are looking to increase their bottom line. So they're raising rents too.
Yep.
But it's incredibly difficult to manage efficiently scattered site portfolios. And so you need to make sure you're aligned with, an operator that has the capacity and the technology and the staffing to do that.
Mm-hmm.
You translate that over to Europe where there it's rented residential, right? So it's 3 flats. It's different. A lot of it's existing. We're building a very small amount of it, but the whole concept around it is sort of new for Europe. Renting, paying a landlord. It's not been sort of institutionalized over there, so it's just starting. So we're doing some of it in Norway. We've been doing some of it in Germany, and it's still in its infancy there, but it's gaining traction again as people. Do I want to own my home? Do I want to rent? What's the difference?
And I see more and more individuals who rent themselves, but they own their rentals.
Sure.
That they rent out,
Yeah,
right? Or
absolutely.
they own multifamily, or they
Yeah.
own other assets,
Yeah.
but they rent themselves,
Yeah,
which is
absolutely.
funny. Yeah.
But that business is, with the emergence of the build to rent and, nobody said millennials wanted to move to the suburbs, remember?
Right.
And now millennials are trying to move to the
Couldn't
suburbs.
disagree more. Yeah.
But it's challenging because it's expensive.
Yeah.
So they're staying in the city a little longer. This next generation, Gen Z, is going to probably follow the same pattern as it might be later in their life, but sort of trying to capture that. And I think that's a lot of these build to rents is we can capture that where maybe they don't want to own, but they do want a house. And they still want the amenities of the apartment building versus putting a pool in the backyard of the house that they're buying, which is expensive and not efficient. So it's funny if you just look back and it's happening, much like previous generations. It's just delayed, and we think it's going to continue to come, which is why you're trying to build product to meet this new demand. It's similar, but it's different.
Tell us, Brian, what of the asset sectors gets you kind of most optimistic, most hopeful? What's showing the most promise right now?
So anything around housing looks good because there's still the fundamental problem of there's not enough housing. Not everything we do is going to address that, but there's sort of an insatiable demand for the product. As long as you're building the right thing in the right location, it should do well. So we're bullish on housing. And manufactured housing falls into that camp as well, because that's sort of capturing the affordable component, which is you're building, whether it's prefabbed homes or whatnot. There's an opportunity there. It is tremendously still fragmented, even though institutions have leaked into it. It's still very mom and pop, very much so. So figuring that part out and how to access that part of the sort of housing segment's important. Senior housing, on the other end of the spectrum, I don't think there's ever been a demographic case that lays out better than senior housing. Right? Now, people have been saying it for a long time, but we're sort of finally here where the number of people turning 80 every year, it's just it's going to continue going up. Now, people are living longer. People are going into them later than I think developers and investors thought they would. But there's demand, and we're starting to see it in the assets. And there is nowhere near enough of it out there to meet the demand. So that's an interesting space. Now, there's a lot of operational complexities that go along with senior housing that we all heard about during COVID.
Yeah, real estate's always struggled with that because it's truly an operating business.
It is an operating business, and it's sort of like a hotel with a hospital built into it. So you need to have hospitality-focused people that also are good at healthcare. There's not a lot of people that do that or are good at it. So the staff is so important, and the costs of it of operating it skyrocketed. They've leveled off. So now there's sort of a new baseline, and you're starting to see some new construction. But supply was completely shut off in 2020, 2021. And so the assets that were in lease up or still under construction, they're benefiting from delivering now, and they're seeing way higher rents than they thought, and the demand is there. The only holdback to some of it is some seniors need to sell their homes to get the equity to invest into the senior living facility. That is holding back, I'd say, the wall of demand a little bit in certain markets. Florida, for instance, the west coast of Florida, the housing market there sort of is frozen. It's there's not a lot of transactions. Values have plummeted. People can't sell their homes. Yeah, a lot of users of senior living who need it, they can't sell their house right now. And so they're sort of stuck, it's a sad thing to see happening, but it's really happening. We had, for the first time ever, a resident in one of our facilities down there that moved in, had investments, they basically run out of money where they had to move out of the senior living facility to move back into their house.
Oh, man.
So you're going to start to hear stuff like that happening. Hopefully, with rates coming down, mortgage rates coming down, it'll loosen up the housing market. So transactions
you would think
will
that
happen.
Somebody would come up with a concept already where you can move them into a facility and then institutionally manage their house and rent it and like offset their costs.
If there's not,
why is nobody doing that? And also, why is nobody doing the 5/2 product where it's just all of your healthcare facilities at the bottom and then residences on top? We should see more of that.
That's starting to happen.
Okay.
You're definitely seeing so you're getting the memory care, the assisted living, and then you're getting the basically age restricted, right? They're living by themselves, completely on their own in a nice apartment. It just so happens to be attached to a place that has all of these things that you can then easily move into as you age.
Happening.
That's happening a lot.
Yeah.
Independent living is what they call sort of what I would call traditional apartment, age-restricted apartments. But more senior facilities now than ever are being developed with that component. So you kind of capture them earlier, then you move them through the life cycle.
Funnel.
That's right. And they don't want to move. They're familiar with it. They like it. They make friends, and they just age in place.
Yep.
So it's working. But that's a very interesting sector. Really, anything out of the alternatives, storage had a rough ride, but it's having its day now again. It's starting to turn around.
Are you seeing that? Because I know that's heavily impacted by the lack of moving.
Yes, it very much so is. But what we've seen is there are other demand drivers that have emerged because it's not like occupancy has plunged. What we've seen is nobody's moving in and nobody's moving out.
Yeah.
So you can still, you have to be delicate with your rents, but we're starting to see rent growth for the first time in a while. There was a tremendous amount of supply that was delivered in self-storage. That's been absorbed. And what we've seen is the utilization rate of storage continues to go up. And it's been on the rise for the last 15 years. Year over year, you're seeing, now it's not, it's not a straight vertical line, but it is a growth curve. And people it's becoming part of how people live, meaning in a city, for instance, New York, it's cheaper for somebody to go rent a storage unit than lease a 2-bedroom apartment.
Right.
But
So
they're
that's
not
what's
living in the
happening.
unit. They're not living in the
Right.
self-storage unit.
They're not living in the self-storage
They
unit.
try
but,
to
but they're
sometimes.
putting their, holiday decorations in there and
Yeah,
then,
right.
moving that out of their winter clothes. They're
Yeah,
using it
of
as
course.
an extra
It's-
closet.
It's an exorbitant cost
Yes.
to move up to your point, right? From 1 to 2 bedrooms, but maybe in the suburbs, I don't know if you have
You're seeing the same thing, and it's because
gotta be, right?
It's because people, even though they can't sell their house or they can't move, they're still buying stuff.
Interesting.
Yeah.
That's
They
an
still are
interesting take.
accumulating stuff.
At one point,
Yeah.
that garage maxes out.
That's a
That's-
very
yeah.
interesting
Right.
take. Yeah.
And that's where we've seen sort of this new demand driver of even people that have been in their home for 20 years, they're accumulating stuff and they don't want to get rid of it.
So they're not moving, but
leasing.
they're still accumulating junk
They're
that they
Jack, I
accumulating
told
stuff.
you had a problem.
crazy.
And I'm
Yeah.
glad that we got it all
I'm
out
getting
on the table.
help for it.
And listen, I've used self-storage a few times in my
We all have.
life, and it's the first thing is to tell my wife, as soon as we're done with
Don't
this,
forget about it.
We're getting our stuff out of here,
Right.
Yeah.
because it's a great mousetrap.
It's such a mousetrap.
yeah.
Wow. It really is.
Well, listen, Brian, this is super interesting. I think you gave us a lot of really good insights to the fun world because there's a lot to unpack.
Sure.
There's a lot that's going on, and it evolves really fast. And it's both very macro and very micro at the same time.
So you seem like
so hats off to you.
You're very much boots on the ground. It sounds like in a lot of different asset
Yes.
types, which
Yes.
is interesting.
You have
Give
to.
it-
You have to be.
Give us when we kind of end this on a positive note. Where do you see the most opportunities? What are you most excited about?
He said
over
the
next-
housing, but
Housing.
Housing
is
and
it-
then alternative uses. Healthcare.
Yeah.
Around healthcare, storage. Again, these alternatives are
data centers, yes or no?
data centers or something.
ended on that note. Data centers,
They're big
are something.
and they're scary. And talk about insatiable demand.
Yes.
But the energy thing has to be figured out, and it requires enormous sums of capital.
Yeah.
So for us, Heitman, we're watching to see what's going to happen because there are still so many unknowns, and to make a concentrated bet into just one data center, that's not something we're willing to do at this point.
Yeah.
If there's more clarity around demand, AI, if there's more clarity around power and how these facilities get it and use it, maybe. But right now it's sort of, we'll sit and watch others tiptoe in and see how it goes.
Very interesting.
All right.
Yeah. Well, I guess we'll wrap it up. But thanks so much for
My
coming
pleasure.
on. We had a
Thanks
great
for
time
coming
here.
on.
I appreciate you guys inviting me.
Yeah. Thanks, Brian.
Absolutely.
Awesome.